Good afternoon and welcome this afternoon to Market Movers. My name is Ben Watson. There are the closing bells, and that means the market is done for this week. And maybe that's true in a number of different ways. We're going to find out today. Hey, Ben Watson here, education coach and senior manager. I am joined out there in the chat by my good friend Brent Moores, who oftentimes will cover this particular webcast for me if I'm out on the road and teaching a live event, which we've done recently. So my thanks to Brent out there. He's going to be there helping to answer your questions in the chat. And together, we're going to close out this week, hopefully in a positive sense, even if the numbers aren't necessarily positive. So let's do this. Let's get into some of the quick housekeeping items first, and then we will jump into what's going on and kind of take a look over the horizon a little bit and see if come Monday, it'll be all right, as Jimmy Buffett says. So remember, everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation. It is not advice. Remember that specific securities that we talk about, any individual symbols, those are for illustrative and educational purposes only. Remember, if you're going to trade options, make sure that you're aware of the fact that options carry a high level of risk. They're not suitable for all investors. Make sure that you read and understand the characteristics and risks of standardized options prior to considering any option strategy. Also, today we're going to be using the Thinkorswim desktop software platform. It's specifically the paper money version. It's a great learning environment. It's a great sandbox for practicing, especially on days like today. It's not a guarantee of future success out there in the real world. Just so that you're aware of that, but it is a good way to learn. We've got lots of resources to learn more about the Thinkorswim platform. Also, we're going to be using technical analysis today. Also, other ways of looking at the market. Remember that any way that you look at the market, whether it is as a sole means of investment research, if you're looking at probability analysis, fundamental analysis, technical analysis, none of those are guaranteed. All of those are theoretical in nature. And remember that past performance, no guarantee of future results. So we're going to talk a little bit about the general trend of the major market indices. We're going to talk about a little bit about what moved markets this week. And we're going to also talk a little bit about the impact to some of these individual positions overall. So let's do this. I'm going to go ahead and I'm going to switch to the Thinkorswim desktop software platform. And as I do that, that's a good reminder to click on that subscribe button down at the bottom of the page if you have not done so already. And that's going to be kind of that opportunity for you to stay connected to the Trader Talks webcast channel on YouTube. It's at no cost to you. It helps you out. It helps us out because it pops all of this content out to the top of the YouTube feed, and that might help somebody else out. So maybe share some of the love here a little bit by clicking on subscribe. Also, if you like today's webcast, click on that like button. As Brent has posted to the top of the chat, make sure that you follow us on X at Ben Watson CS, at Brent Moore CS. And we post a lot of great content over there. So, speaking of great content, let's take a look at what's going on here today and taking a look at what's been going on with the market. PCE, the big metric that the Fed uses, and if you want to think about it from that particular perspective, the price inflator. That particular technology or a data point being something that the Federal Reserve looks at pretty closely could have been what took the market down. It could be just that it is Friday. It could be the fact that you started to see more of a sell-off in, again, some of the Mag 6/Mag 7 stocks. We saw a breakdown in Tesla. We saw a number of other positions making a move to the downside. Let's kind of cast our eye around the indexes first, and then we'll take a look at some of those individual positions. Along the way, we'll break things down, other markets that might be moving, what's going on in gold and in fixed income and in energy and in other spaces. But let's take a look at the SPX first. And, you know, we've been trending under this 200 period moving average. We saw a little blip above. We couldn't hold above the 200 period moving average. We had a bit of what was referred to in what I posted on X as an abandoned baby type of candle pattern. Now, this is also kind of a version of, generally an abandoned baby has a bigger gap. This is maybe a version of what we might refer to as an evening star type of candle pattern, kind of the sunset of a short-term uptrend. And so you see that particular perspective. And we see a little bit of a move down. And today was a little bit more than a little bit of a move down. In fact, today on the SPX down almost 2%. On the week, down a net 1.5% in this particular case. Now starting to see that move kind of extending itself. Now, what's interesting is, as this is kind of settling out, as the closing bell happens, we're down just barely off, just barely off of the low for the day. The low for the day on the index, here in this particular case, 5572.42. The closing price, 5580.94. So a little bit of buying stepping back in and kind of bringing this up off of the daily low. And in fact, if we go to a 1 day, 1 minute chart, you can kind of see where that occurred. The majority of the damage was done early on. That's what tells me that this is likely to be kind of that initial impact from PCE and other data, although we had consumer sentiment that was maybe a little bit better than expected. I mean, not hugely, but a little bit better. Not as bad as was expected, perhaps, maybe is the case. But you saw most of the damage done in the first few, maybe in the first hour or so of today's market, and then it continues to kind of slide off. You see a little bit of a stasis here as we get towards lunchtime. Traders go to lunch. Traders may be bailing early for the weekend, and that happens. I mean, traders are human, right? And we see this kind of sideways movement. So I think maybe if we can pull something out of this perspective, right? And we can pull something to not necessarily hang a bullish hat on, but at least hang our neutral hat on. And that is that for the majority of the day, after about that 10 a.m. time frame, Mountain Time, if you want to think about it, because that's where we're looking. I'm looking at these numbers here. We saw sideways movement, really no movement whatsoever, right? And I think, Carol, you're absolutely right. I mean, I think everybody worried about next week's potential tariff impacts. You know, not a lot of investors, retail or otherwise, wanting to maybe hold on to potential long positions ahead of next week, because we've already seen kind of readjustments and changes to policy expectations and to the time frame and the timing and the status of and the significance of some of those tariff impacts. And so this creates uncertainty, and it has created uncertainty in a rapid rate. And the market can deal with uncertainty. The market doesn't deal well with uncertainty that occurs quickly. And so I think that's what we were seeing here early this morning, and now coming into the end of the day, it was just a matter of kind of rebalancing. But there was a little bit of buying going on at the end of the day, kind of picking things off, closing things down, bringing price up off of the bottom. If we go to the NASDAQ, a little bit broader move to the downside, 2.61% to the downside on the NASDAQ today. We can see that right up here at the top. Weekly damage to the NASDAQ down 2.39%, monthly down 0.768%. Year to date, not quite in a correction yet, but for yearly, but down 9.04%. Right? And, you know, that's a good question. I mean, last week we had, Carol, we had kind of that upward lift, right? And you know, we could look at this and we could say, all right, here's last week. We saw the little bit of a move to the upside. Last week we were up about 4%. This week, if we were going to take it just kind of from this perspective, here's Monday and into today, down 4.72, although net kind of down 2.39 based on what it moved. So, you know, that standpoint, right, down on this support level. Now, here's the again, maybe the positive thing. NASDAQ 200 period moving average still going sideways, not quite turning down. Let's zoom back out to our 1 year daily chart on the S&P 500. S&P 500 200 period moving average still moving up, still making a higher low, right? higher low, higher low, higher low, right? Equal low in the NASDAQ, not a lower low, equal low. So if we were to look at the last 2 weeks, last 3 weeks, this has been sideways movement under the 200 period moving average. Okay. All right. So from that standpoint, this has been sideways, and oscillation in a sideways trend isn't, isn't anything but that sideways trend, right? The RSI kind of breaking this uptrend line, and we see this diagonal uptrend line right there on the RSI yesterday and today, breaking down through that diagonal uptrend line on the RSI, kind of disrupting what was a potential reversal. So does that mean this can't bounce? No, it can't, because look, here's what's going on. Even though, look, and I want to focus on this. So let's kind of stay on the side of the absolute reality of the situation. The absolute reality of the situation is we have a bit of a bullish divergence going on, right? And though we have, and on the NASDAQ, I think that becomes more significantly important than on the S&P 500. S&P 500, we have the same thing, but it's kind of echoing price. You got a higher low on the S&P 500 price. You've got a higher low on the RSI print as well. Not a divergence. That's just echoing what price is doing. It's not breaking down. You could maybe say, look, we've had these rallies up and then it breaks down, rallies up and then it breaks down. And each one of those eventually has been broken. We're not there yet. But on the NASDAQ, right, we've had these bullish divergences or echoing upward movement. This is a solid divergence, right? I mean, let me grab my magic marker to line this out. I don't want to discount that, but neither do I want to necessarily place an overabundance of importance on this, right? We have higher lows on the RSI. We have equal lows on price. That is a bullish divergence. Bullish divergence in that the price of the index is making an equal low. But the RSI, that momentum and sentiment indicator, indicated by the candles and where those candles are closing, is making a higher low. So the presumption is this, right? The presumption is this, that if we get sideways movement and the RSI is ticking up, that buyers are starting to step in, right? Buyers are starting to step in and push this back up. I don't want to discount this because this can be significant. And here's the reason why. This becomes, I think, more significant than if we had a bearish divergence, right? Where RSI was turning down and price was going up, still coasting higher. This suggests to me not the market driving the price down, right? Not driving and pushing, even though it was a big down day, yes, for sure. But it wasn't driving below a support level. It wasn't driving below the RSI. It wasn't pushing the RSI to a new low, down to an extreme. It was still holding this support level, and that suggests that maybe this holds this sideways movement into the next week, into whatever catalyst might be out there. Don't know what this April 2nd day is going to bring. It might be as confusing as today. It might be as uncertain as today. Now, let's take a look also at the Russell 2000 here, because the Russell 2000, with this being small caps, again, we see price making a higher low. We see RSI making a higher low. And if we're just kind of comparing these 2 points, so you say, wait a second, maybe if we do this, maybe if we go here, then that's breaking that level. We draw that diagonal line there, and it's breaking that level. And you can draw that line to break it wherever you want. But I'm drawing these two major lows, right? And we had a big down day today in the Russell 2000, 2.5%, 2.05%, on the week 1.64%. So it's down sitting at that level. RSI is still echoing that price movement. So there's still some bullishness, still meaning that there is buying pressure stepping in, holding this up on this diagonal trend line. What it doesn't necessarily suggest, because it's not a divergence, this is echoing price, is that there's buying pressure that's kind of sneaking in, right? That's kind of sneaking into this area. So this is something to pay attention to. I mean, I think if you think about where the damage has been done primarily, it's been in some of those Mag 7 stocks, right? And that's where we get to that impact of on the S&P 500 as opposed to the Russell 2000. But the Russell 2000, there might be a mitigating factor here, right? We've talked about this from the impact of the 10-year yield or the interest rate on the Russell 2000. So what I'm going to do really quickly, and I've done this before, I'm going to do it again. I'm going to go up to the studies and I'm going to add a study, and we're just going to do a comparison study. And I'm going to come over and I'm going to go custom symbol. Now, what I'm going to use here in this case as a proxy for rates is the futures contract, not the futures trading market. We're not trading this, but the futures market /10Y as a proxy for rates. 10Y is the 10-year interest rate, right, as portrayed by the futures. And that's currently sitting at 4.25, all right? It's got a pretty good support level at about the 4.12 mark. It's not down near there yet. It hasn't been going down significantly. It's been kind of holding up. And you can kind of see how the Russell 2000 has been following along in recent days with that move, which is interesting because as the rate goes down, generally that benefits the Russell 2000. And I think ultimately it will, but it's kind of buoying this up maybe a little bit here. But the other side to think about is this. If we were to change this, so I'm going to go over my single grid for just a moment, okay? And I'm going to go over here to the, I'm just going to bring up my single grid, which is kind of my sandbox for playing in this area. I'm going to look at /ZN. Again, I'm not using this as a tradable instrument. I'm using this as a measure of market movement. So this is /ZN. Okay, and let me kind of move that label around so that you can see it. And this is 1 year, 1 day. Disregard the label. It's just take the label for the name of what this is, not the time frame, because this is a 1 year daily chart. So this represents the 10-year bond market. Okay, so what this suggests, look at the big candle here on the 10-year bond market. This is the 10-year bond price itself. What this tells me from this perspective is that buyers were coming in and buying bonds. They were rotating out of stocks and buying bonds, perhaps as a safe haven over the weekend and through that April 2nd target date, right? Whatever that catalyst might very well be. But they're stepping in, buyers were stepping in and buying bonds. That was pushing yields down. Bond prices go up, yields go down. Bond prices go down, yields go up. That's the inverse relationship between bond prices and bond yields. And so we've got some great resources that talk about that. Mike Fairborn's market and sector analysis, James Boyd's growth and value investing. Both of those talk about some of those areas of fixed income. We've got some great research resources available on schwab.com with our Schwab Center for Financial Research and other resources that are available that can help you to understand this relationship. But bonds getting bought up today is generally an indication that stocks are rotating down. Investors, institutional investors, retail investors, rotating out of stocks for the sake of the supposed safe haven of the full faith and credit of the U.S. government, right? That's the presumption, okay? But while we're here, we might as well take a look at where they might also have been rotating, maybe if they were, /GC, is gold. And I don't care if you're a gold bug, I don't care if you're a gold skeptic, but gold has perennially had the presumption that it is a storehouse of value because it has intrinsic value, right? I mean, it's pretty, right? Gold looks nice. It has weight. It has gravitas, if you will, right? You carry a gold bar around. That's got heavy. You can hit somebody in the head with it, for crying out loud. But you can also shave off pieces of it and trade it for other things. It's fungible, right? And it's malleable. You can make it into coins and other things. You can use it in industrial purposes. So it has a storehouse of intrinsic value. It also has this kind of presumptive storehouse of value as a safe haven, right? That if bonds are changing, if stocks are changing prices, that money flocks to that safe haven, that presumed safe haven of gold. And we see the gold movement in the last couple of days. We see a big breakout, in fact, of gold. This is the gold futures contract, so we're using this as a proxy for spot gold. But this would suggest that buyers stepping in to the gold market and buying gold, whether those are individual buyers, whether those are institutional buyers, whether they're buying gold funds, whether they're buying spot gold, whether they're buying bullion, or whether they're sovereign entities buying up gold for that storehouse of value. You also have kind of geocultural impacts to gold, right? I mean, you have gold buying going on in countries where, from a ceremonial standpoint, it's nice, and it's also a storehouse of value when other functions of banking aren't working as well. When there's a risk of devaluation of currencies, gold becomes a value and a storehouse of that value. So what I'm going to do is I'm going to go to studies, and I'm going to do add study, and we're going to compare with, and we're going to go to custom symbol, and we're going to compare with /DX, which is the dollar futures. So you can kind of see the oppositional move. I'm going to change that RSI here really quickly to correlation. And we'll do a correlation study here really quickly, not to the SPX. We're going to correlate gold here, in this case, to /DX, and see how gold correlates to that dollar movement. And you can see if we were to put our zero line in here, here's our zero line. It's kind of all over the place, right? It's up and down. Right now, it's on a positive correlation, but it has been in kind of that negative correlation. So you've seen flocking out of the dollar. We've seen dollar weakening a little bit. That's what this tells us right here, is the dollar weakening. And this tells us that the gold market is benefiting from that, right? Now, is it gold devaluing the dollar? Not necessarily, right? I mean, you could argue that there's a lot of reasons why gold, or why the dollar is getting devalued, right? Okay. And a lot of that has to do with interest rates. A lot of it has to do with, where our positioning is with things like euro dollars and petrodollars. We could go down a big rabbit hole. Let's do this, though, really quickly. I'm going to just /SI. We'll take a look at the silver futures while we're here again, because that's also considered generally to be a storehouse of value, but not nearly so, not nearly as much as the gold market. But this has industrial demand, more so than gold does, silver does. And silver trying to break out today and make that move higher. Now, I'm going to keep that dollar comparison up. I want to look really quickly here at /CL, which is crude oil. And we'll see that dollar comparison. And generally, the dollar and crude have been moving in a pretty tight 1-to-1, almost 1-to-1 correlation. They are now. Dollar down, crude oil down, which is interesting, because crude oil generally denominated in US dollars, when the dollar falls, that typically tends to push crude oil up. But now we have a situation where crude and the dollar are moving in lockstep with one another. And here's the thing. And if you watch the Schwab Network and you see Oliver Rennick, Schwab Network is brought to us by our media partner, Charles Schwab Media Productions, a separate but affiliated company. If you watch the Schwab Network, you watch what Oliver talks about especially on his Risk Radar, which he's doing right now on the Schwab Network. One of the things he talks about is when normal relationships start to break down, that's a signal of uncertainty, right? And I think we're kind of seeing some of that here going on, with the dollar and crude kind of separating from one another, generally because they move in opposition. When the dollar moves down, crude generally moves up because it's a weaker dollar, and crude prices then go up. When the dollar moves up, generally crude prices go down because it's a stronger dollar, right? And so we're not seeing that normal correlation here in terms of this move. So I want to do this. I'm going to switch my grid really quick, and we're going to come back down here to our yield versus the S&P 500. So we're kind of rotating back into this. Oh, by the way, Notice what happened with the volatility index, the VIX today. We see gap and a move and a little bit of coming off the top. I mean, that's normal. We see the VIX starting to mean revert just a little bit. We're not seeing a big, huge spike. And again, that's what maybe sends that message, that part of that message that yes, there's volatility, but no, it's not panic. We're not seeing a unique, discrete panic like this exquisite point right here or this point right here. We're seeing a little bit of an upward move in volatility, right? Okay. So now we take a look at a couple of things here. Here is the market, SPX, the broad market, compared to the 10-year yield. Now we're back to interest rates. Interest rates down, SPX down. And you know, you got to think about this from that standpoint. What's going on here? This again means this lockstep correlation means or reinforces that one that we talked about, right? Where if there's money coming out of stocks, where is it going? It's not sitting on the sidelines because the dollar is weaker. So it's rotating potentially into fixed income, into bonds. And that's why we see the yield coming down. We see bond prices going up. /ZN, remember, is that futures that helps us to measure what's going on in that 10-year bond price. So if the bond prices are going up, yields are coming down, that should theoretically benefit interest rate sensitive areas of the market. So let's do that. Let's look at areas of the market. Let's look at sectors of the market that might be moving relative to kind of this relationship with what's going on and see what they've done today. So I'm going to go to my grid right here, and I've shared this grid before out in the description page. Yeah, Floyd's Garage. Yeah, bonds moving higher, sign of risk off, right? Protective asset, interest rate sensitive assets, right? That would be benefiting from lower interest rates. That risk off perspective. So I'm going to change my grid here to my SPX sector index grid. And I've shared this before. I will do it again. And remember, anytime we share a grid or we share any kind of an item here, it is for illustrative and educational purposes only. It is not guaranteed as to time or accuracy. So I'm going to just share it here in the chat. And I will put it, I'll make sure that it is in the description. I'm pretty sure it's in the description now. But now you've got it there in the chat as well. And all this are the sector indexes, right? These are the individual sector indexes. This one down here, because this is a 5x5 or 5x2 grid, or a 6x2 grid, it gets us to 12, right? So it gets us to our even number because there are 11 sectors. So I've got the SPX down here doubled up. So let's do this. I'm going to maximize each one of these grids, and we'll just kind of go through these, all right? Yeah, speak truth. That's a good question. Is there any time period that comes to mind that resembles the current market correlations, divergences, and so forth? I don't know. I'm going to have to go back and look. It's not 2008. It's not the financial crisis. I mean, much more significant impact happening on the financials in that particular case. Maybe 2002. That's a good idea. Floyd's Garage. We'll maybe take a look here in just a minute. But let's take a look here now at energy. And again, this is going to follow largely with crude, but differently than crude necessarily. You see kind of moving, kind of with crude moving sideways, and the trend, this is a 50-period moving average. That's what I'm going to kind of go as my designator here of, is it going up, down, or sideways? Energy kind of going sideways, and it's been going sideways. Having a hard time kind of getting out of its own way, getting up above some of these resistance levels, especially when crude has been moving lower. So we've seen crude move lower. Crude's the primary driver of the energy sector, period, end of story. Natural gas helps. Heating oil's part of it. Gasoline's part of it. But it's primarily crude. And it's crude price that will drive energy. And we're kind of seeing that go sideways. All right, let's take a look at the next one. That's materials. And this is going to be largely energy as well, simply because petrochemicals go into a lot of materials, right? Now, this also includes industrial metals that are mined. I mean, that kind of falls in this material space as well. These are 1-year charts. These are 1-year daily charts, okay, of the sectors. And you can see a big move to the downside today. And again, I think that may be some of the impact that we've seen to some of the mining stocks, some of the battery stocks, not necessarily reflective of gold. But hang on, we're going to come back to gold. Do me a favor, somebody keep me honest here and remind me to rotate back into gold in just a minute here when we get back to this, because I want to get back to that gold perspective. Okay. And I want to talk a little bit about the gold halo. So industrials getting hit. And again, manufacturing, consumer confidence, we had durable goods orders earlier in the week that were strong, right? So we would think, wow, industrials would be moving higher. But again, there's that kind of that risk off perspective in this particular case. So risk off hitting industrials today in that broad sector, hitting consumer discretionaries. I'm going to have to adjust my label because I think it ran off the edge of the chart there, but I'll bring that back. So consumer discretionaries, those are the things that people want to buy, right? And this market up until the end of the year really kind of was driven largely by consumer spending. Airlines, consumer goods, luxury brands, clothing, shoes were all driving this consumer discretionary sector higher, including, things like Walmart that had kind of rotated into this consumer discretionary space as opposed to retail. I think maybe becomes more of a discretionary. But down on the day today. Now, consumer staples. And again, this goes along with the idea of that protection, right? Protective assets, defensive assets. Those that are a little bit less interest rate sensitive, the things that we have to buy, risk off. All these ways of describing the market is exactly what we're seeing here with consumer staples rotating higher and starting to make that move to the upside, even though consumer staples today getting hit a little bit, but not hit to the same degree. But as Pat Mullally used to say, when they raid the house, they get everybody, including the piano player. And I think this is an indication of getting everybody, including the piano player, right? So healthcare, seeing some potential strength, not really getting hit hard today, although they got whacked earlier in the week, right? A big down move off of that reversal. So what I think maybe you see happening here in healthcare is kind of this skewed, lumpy head and shoulders with the potential to make a move to the downside, depending on, things like tariffs, depending on policy influences, those types of things. Now let's rotate to financials. And this has been that area that has been relatively resilient, right? I mean, this has been kind of the economic engine, if you will, despite what information technology and communication services have been doing. Through it all, financials have been kind of rolling higher, and they are still. But we now have a new lower high. So the question becomes, and the mark to really potentially to pay attention to is right here about 783. And when we think about it in the index, and what that means is a new lower low in the broader context. So financials getting hit a little bit here today. Now, here's the thing. Starting in about a week from now, we're going to start to get bank earnings bleeding back in. They tend to be on the leading edge. Banks, financials tend to be on the leading edge of earnings season. So we're going to get an early read going into Q1 earnings relating to Q1 performance. So that's going to be the first quarter with the significant majority of that quarter with the new administration and new policies and new uncertainties. So it'll be interesting to see what happens with the financials as we go into this earnings announcement. Now, information technology has been bearing the brunt of this sell-off. Information technology making that move lower today, down below this support level. So now here's what we have. We didn't before. I mean, we did, yes. I mean, you could maybe call this an equal high area, and we had a lower low. But now here's what we have is a confirmed lower high, lower low. It's moved lower. That's a bear flag, right? That's made that move lower. This isn't a bear flag type pattern. Will it continue? If it does, you've got some measured move targets, right? Down here in this range, down off of those September lows, right? That it may potentially move into. Now, communication services, right? And the same thing, bear flag, breaking below those lows, although maybe arguing that it could be sitting right at those lows. So same type of thing, 200 period moving average rolling over. Utilities, though, on the other hand, an up day. Now, here's where, as opposed to what we saw in the Russell 2000, right? As opposed to what we saw on the Russell 2000, which was a normally interest rate sensitive area of the market because they're small caps, getting hit on a day when interest rates went down. Utilities, which are also interest rate sensitive and maybe for a longer lead time, moving higher on the day, starting to benefit almost above the 200 or the 50 period moving average here in this particular case, almost regaining that. But this is a longer term squeeze in those utilities. And then real estate, again, interest rate sensitive, just kind of sitting where it is. And we see this little bit of a squeeze here at the moment below that 50 period moving average. So the interest rate sensitive sectors doing better than the interest rate sensitive indexes because, and I'm going to make this argument, I'm going to go back to that group that our YFT index group, and we're going to take a look at the Russell 2000. That when they rebalanced the Russell 2000 in June of this last year, and they will rebalance it again in June of this year, as they always do every June. The rebalance brought this the weighting of technology in the Russell 2000, because remember in June, what was technology doing? It was rocking and rolling, right? So the rebalance was based on what was strong at the time, and is that case, and that's why they rebalance every year. But the weighting in the index was shifted to be about 20% or a little bit more, weighting towards the side of technology as opposed to perhaps financials. And so I think that's one of the reasons why maybe some of the common relationships that we notice with the Russell 2000 are breaking down a little bit, maybe one of those areas, right? Okay. Thanks, Wiley, for keeping me honest here. I don't want to get away from this. I want to pop back to my single grid. And I'm going to come back over here to the single grid. We're going to keep the RSI on here. I'm going to bring up /GC. This is gold. Okay. So if gold is this strong, right, and it appears that it has been persisting this strong in this, this is a 1 year time frame on the chart. It's been trending up this whole time. It's not had new lower lows in the context of this trend, with the exception of that little bit of a November pullback, which, again was, hey, the euphoria about, wow, Bitcoin potentially, right? Or cryptocurrencies being potentially the new storehouse of value. So if this gold price continues, then here's what's going to happen at some point, right? This is going to bring, it's like the law of supply and demand, right? When you have high prices, the cure for high prices is high prices, because then you get other sellers coming in. Well, okay, cool. If gold is persisting up here around $3,100 an ounce, guess what's going to happen to those gold miners? Those gold miners are going to start mining, trying to mine more gold. Period. End of story. I mean, it doesn't matter what the sovereign holdings are. It doesn't matter what the flow of bullion is. This is going to attract gold miners. If you've ever watched Discovery Channel's Gold Rush, guys on that show like Parker Schnabel are all over this, because, wow, I can now invest more money, borrow it at cheaper rates, invest it, and buy enough equipment to mine gold when it's trading out of the ground at $3,100 an ounce. So what do they have to have in order to do that? They have to have equipment, right? So let's kind of rotate in. And again, AEM, Newmont Mining, others. Let's take a look at AEM really quickly here. We'll go to some of these individuals. Look at what AEM, it's echoing what gold is doing. Newmont Mining starting to try to break out here today. American Barrick and others starting to do the same thing. But what these companies need to do, right, is they need to buy things like tires, right? Goodyear Tire and Rubber. Take a look at the upward trend here that's happening, this bullish divergence that's going on. Even though we saw this little bit of a pullback here in Goodyear Tire, this is a long lead time, right? It takes a while to build those tires, to make those tires, to sell them, to get them on the trucks. But then when you've got the tires, right, you got to have trucks to put the tires on. So you go to Caterpillar. Caterpillar not necessarily seeing that turn yet, but they're holding their own at least at this point. And they've got a bullish divergence on the RSI happening right here. And then you got to put engines in them. CMI. And again, bullish divergence on CMI in that gold halo. So, as you look at these forces that are working, these are some of the things that maybe you start to look at around the edges. If gold's persisting in that strength and you start to see that strength bleeding back into some of these things, right? Goodyear Tires, Caterpillar, Cummins Intermountain, those types of stocks, that's where you're going to start to see some of that lift and that rotation of money, because institutional investors know that if gold is persisting in that upward trend, that there is going to be other areas that are going to present opportunities. So that's one of the things you might look at. Again, remember, none of these individual symbols are recommendations. But what I wanted to do really quickly as we kind of wrap this day up and this week up is I wanted to look at our Market Watch tab here, first of all. And what I thought was really interesting, so this was the top 10 net gains on the NYSE today. This is the watch list. This is a dynamic watch list. Top 10 gains on the NYSE. And we take a look at the top gainer here, or the second top gainer. That was AppLovin. Okay, I'm going to pop into AppLovin really quickly here. We'll go over to the chart. And I looked at this earlier on the network with Jenny and Oliver this morning. And you see what's going on with AppLovin. Again, a little bit higher low, a little bit of a bullish divergence. But this was the top gainer for the day on the NYSE, right? Holy cow. And it was down and then saw a little bit of a buying pressure to the upside. So from that standpoint, when they raid the house, sometimes they get everybody. So the other thing I want to look at really quickly as we kind of wrap this up, I want to go to the Visualize tab and I want to look at the S&P 500. And holy cow, that is bright red, right? I'm having to step back to avoid getting the sunburn on the screen. But, as Richard Dreyfuss said in Close Encounters of the Third Kind, so this is important. This means something. The fact that this is broad-based, it was across the board, but look at where it hit the hardest. Look at where the brightest red was in those large cap stocks, right? And then you start to look at where maybe it wasn't hit quite as hard, was in some of those mid caps, kind of the middle-sized companies. And then when you started to see some green, look at where the green was. Healthcare, you start to see some individual names here in healthcare that were doing okay. But where the green was, where the remaining green, those little islands, those little green beans in a sea of red, if you will, right? Utilities, interest rate sensitive. Real estate, interest rate sensitive. Consumer staples, defensive and protective. So, and then maybe over here in some of these financials as well. But boy, this is important. This means something, right? This is risk off. And I think it's risk off until we get to that that date of uncertainty, that event horizon that's coming up. So let's take a look at what's going on next week, just from an economic calendar and an earnings standpoint. So taking a look at some of those Econo Day events for next week. Let's see what we get here in next week. And we'll just show all. And here we are next week. That's actually this week. Let's go to this week right here. That one right there. There we go. All right. So coming up on Monday, we've got retail sales numbers, we've got CPI, we've got more retail sales, PMI manufacturing numbers, we've got JOLTS, we've got flash numbers coming up, we've got mortgage applications, factory orders, and then, Wednesday is kind of that line of demarcation, right? And then Friday, as kind of corroboration, we've got the employment situation and Baker Hughes rig counts. So there's going to be two things, at the end of the week, next week, that we'll talk about in this discussion. We'll break down that employment situation report. But until then, I think it is realistically one of those situations where you take a look at the market, you say, hey, we're going to look at this index grid, we're going to look at this trend. The trend, if you look at the 200 period, is kind of the weather vane, if you will, the long lead weather vane, still trending higher. Still trending higher, starting to go flat. And so I think you've got to kind of keep it in that perspective. And there's kind of the view across the valley. Yeah, there is a rapid rotation occurring. I think there is some greater uncertainty. Like I said, the market can deal with uncertainty, and it deals with uncertainty by adding volatility. What the market doesn't really deal well with is a lot of additional uncertainty in a very, very short period of time. And I think that's what we're seeing here. And we're still seeing just kind of that no traditional relationship still working, except for maybe gold, right? So, call it a golden weekend. We'll see what happens. Let me ask you this. How crazy is this that they're combining? I'm throwing this out as an aside, just something that you think about for the weekend. Why are they putting the Golden Bachelor together with Bachelor in Paradise? I don't know. Who wants to see Golden Bachelors on the beach? Just saying. Anyway, as I always end up this webcast with on Friday afternoons, for all of you, and thank you for being here. My thanks to Brent Morris for helping out. My thanks to our great production staff. If you want to learn more about this, come on over here to Schwab Coaching. Come on over here to Trader Talks webcast, or Trader Talks webcast channel. Click on subscribe. Search for what you want to find. Lots of great educational resources here. And as I end every week, guys, keep your arms and hands inside the ride at all times. Hang on and have fun. And we will see you guys again next Monday. Take care, everybody. Bye-bye.